Are you trying to make a big purchase, pay off debt, increase your credit score, or increase your savings and investments? These are all big financial goals that are very attainable. Join me in this video and let me teach you how to create your best financial plan for the year 2025. Hi guys, welcome back to the channel. My name is Tega, and if you're new here, welcome. If you're a returning subscriber, thank you very much for coming back. So today we'll be talking about how to create smart financial goals for the year 2025. I know we have started the year, but I have this feeling that some people haven't created their financial goals yet. So if you are part of those people who haven't concretely decided on what to do financially this year, then this video is for you. In this video, you would learn how to create smart financial goals that are attainable and that can be achieved, and how to break your goals into smaller units that you can actually measure monthly and see how you're doing financially. Step one to going about achieving your financial goals this year is first to assess your financial state. This basically is just knowing what's your total income for the month or the year, what's your total expense for the month or the year. This is inclusive of fixed expenses and your variable expenses. Also, your total amount of savings and investment as at now. How much do you have saved? How much investment do you have? And then the last will be to track your debts. So have a compilation of all your debts, know what the total amount is, and then be aware of the different interest rates if you have different buckets of debt. So if you have credit cards, know what the interest rate for the credit card is. If you have maybe personal loans, a car loan, or any other form of loans, know what their different interest rates are so that you know how to tackle them and which to tackle first. Also, you could arrange them from highest interest rates to the lowest interest rates and then go about tackling them that way. By understanding where you are financially, it will help you create realistic goals and attainable goals. It will also help you know your financial state and know precisely what you should be chasing, whether you should be chasing investments or savings, or you should basically be chasing bringing down your loan if you have a lot of loan, for example. Step two, ask yourself what is most important to you financially. What would you like to achieve in year 2025? And some of these examples would be saving towards your down payment for a house, or saving towards buying your car outright, or investing in stocks, mutual funds, real estate, maybe getting a rental property, paying down your debt completely and not having any debt again. Increasing your credit score is also one of them. And also investing in retirement, investing towards your future by maximizing your RRSP or your 401k account. So basically, it's to know where you are at when you have done step one, which is knowing your financial state. Then you know what is more important to you, and then that leads us to step three. Step three is set smart financial goals. So SMART is an acronym for longer words, and they all stand for different things. So S stands for specific, M stands for measurable, A stands for attainable, R stands for realistic, and T stands for time bound. So you can measure it with a particular time. An example of this would be to pay down a debt. Let's say the debt is $2,000. Now the SMART acronym, the first to be specific. The specific thing we want to do is to pay down $2,000. So I want to have paid down my $2,000 debt by December 2025. Measurable would be breaking down $2,000 from this month, which is March, till December, and seeing how you can pay that. So you could, for example, we have 10 months, break it down to paying $200 every month to the end of December, and then it will be gone. Achievable would be how you intend to go about achieving it. So basically, maybe stopping a subscription or reducing non-essential expenses, like limiting shopping on clothes or stuff like that. R will be how relevant it is to your goals. So it's relevant because if you pay off your debt, then you may increase your credit score, you may have more disposable income to save and invest. So that's how it's relevant. And T will be what time did you put to achieve this goal. Now the time you have put to achieve this goal is to have paid down the debt to zero as at December 2025. This you can do for paying down debt. You can do that for savings, like having a specific amount you want to save and break it down into months or bi-weekly or semi-monthly, depending on when you get paid. Step 4 is break down your goals into smaller bits. When you break down your large goal of, for example, achieving paying down your debt of $2,000 into smaller bits of maybe paying $200 every month, you would be able to know when you have achieved it. So at every month, you have to now track and see, did I move money towards this debt? And then you look at what's left or the balance of the loan and like re-strategize or work towards continuing the payments. Now, you could also track this monthly or quarterly. Actually, you could track this monthly and quarterly. So you track it monthly by, I paid 200. By the quarter, you should have paid 600. So a quarter is 3 months. So you should have paid 600. And then you keep tracking it that way. That way, you don't get to December 2025 and realize, ooh, I didn't pay it, because you have been tracking it in small bits and you have been paying it in small bits. If you try to pay it at once, it may be harder for you to achieve because you have other things to do with money. But if you break it down into smaller chunks, it makes it easier to attain. So step 5, to make this even easier, it's easier for you to just automate your payments. If you're saving towards investment, retirement, or contributing towards your IRSP, you can just automate it so that you don't even have to think about it. You just have to track that that payment has been made. If you are also trying to pay down your debt, you can also automate a particular amount going towards that. Like the case scenario of $2,000, automate to 200 every month and just let it be going. So all you have to do is just monitor it or check that it has actually been taken. Now, the last step will just be to keep monitoring it, basically. Keep tracking that you're making progress. And as you're making progress, if anything changes in your financial situation, you obviously can either opt your goals. Like your goals doesn't have to be stagnant in the year. If you get a pay raise or you get some free money, for example, tax season is coming. When you get your tax refund, if you wanted to pay down your loan or you wanted to invest or save towards investment or your emergency funds, if you get a huge chunk of money that you did not plan for or it's not part of your monthly income, you could actually take a larger chunk towards either reducing a loan or towards retirement, because you're still going to be good without it anyway. You've been living without it and you would be fine without it. So maybe take a like 80% of it or 60% of it, a percentage you're willing to part with and put towards that. If you're trying to achieve saving a particular amount, every month you should see what progress you have made, how much you have saved, and that would even encourage you to save more. So have a tracker, like an account or your budget tracker or something that you see the progress you're making. And then quarterly, you could also check it. And then at the end of the year, obviously, you'd have to review and see how you fared, and then look at things you can do differently or do better or improve and continue this process. Tips to achieve this success is: first, stay realistic. So don't have a goal that you know you cannot attain or you know you need like intervention to attain it. Set realistic goals that you know you can work with based on your expenses, your income. Two will be to track it. Don't just leave things to chance. Just because you automated your savings doesn't mean you shouldn't track it. So, or you automated the payment does not mean you should not track it. And then be flexible. So life happens. I mean, you could have saved up some money that you were trying to have towards investment or something, but life happens and you have to spend some of it. That's part of the reasons why we should have an emergency fund. Be flexible, but be focused. We've come to the end of this video. Please give us a thumbs up, like the content, comment, share with your friends that need this advice, that also need to create their goals in 2025. The year is not too far gone for you for you to create your goals. And you could also check out other videos of mine that I've done on budgeting. And then if you want to see a particular video on anything financial, you can leave it in the comment section.